Welcome. You're watching CA Wealth Workshop, where we turn complex tax law into powerful wealth strategies. I'm a chartered accountant with deep expertise in international tax planning and advanced US tax optimization. Today, we're unpacking one of the most searched tax issues in the United States right now: the proposed 2025 change to the SALT deduction cap from $10,000 to $40,000. This is more than just a policy tweak. It's a strategic shift that could dramatically improve the financial position of high earners, especially in high-tax states. Let's start at the foundation. SALT stands for state and local taxes, which include your state income taxes, municipal taxes, and property taxes. Since 2017, Americans have been capped at deducting just $10,000 of their SALT payments on federal returns. That cap hit hard in states like New York, California, New Jersey, Connecticut, and Illinois, where state and local taxes can far exceed that threshold. Now in 2025, Congress is evaluating a bipartisan proposal to increase that cap to $40,000, applicable to households earning under $500,000 annually. And it would be indexed for inflation, meaning it can grow year after year. Let's break that down with real examples. A dual-income household in San Francisco earns $370,000 and pays $16,000 in property tax and $18,000 in state income tax. That's $34,000 in SALT. Under current rules, only $10,000 is deductible. Under the new cap, they'd deduct the full $34,000, potentially slashing their federal tax bill by up to $8,400 at a 35% rate. In New Jersey, a family making $420,000 has $30,000 in combined property and state taxes. That's $20,000 more they could deduct, possibly saving $7,000. Or take a New York tech lead earning $280,000. She pays $18,000 in city and state taxes. Today, just $10,000 is deductible, but the proposed cap lets her claim the full $18,000, a boost of $8,000 in deductions. Even in Washington state and with no income tax, high property taxes matter. A consultant paying $12,000 in property tax could once again deduct the entire amount, previously blocked under the Tax Cuts and Jobs Act. Here's a fourth example involving a business owner. A married couple in Illinois earns $450,000. One spouse is a corporate employee, the other runs an S-Corp. They pay $24,000 in property taxes and $13,000 in state income taxes. That's $37,000 in SALT. They've been capped at $10,000, but under the proposal, they'd get $27,000 more in deductions, resulting in $9,450 in tax savings. That's massive for high-income entrepreneurs in progressive tax states. Now, a quick reality check. There's a common myth that SALT deductibility is only a blue state concern. In truth, many middle to upper middle income families across the US are affected. States like Minnesota, Oregon, and even parts of Colorado and Georgia have residents crossing the $10,000 SALT threshold just through property taxes and state levies. This isn't just about Manhattan or Silicon Valley. It's about teachers, consultants, small business owners, people with strong regional incomes and moderate to high living costs. Now, what should smart taxpayers do? First, reevaluate your filing strategy. Itemizing becomes more attractive in 2025. The standard deduction for married filers is projected at $29,200. If your itemized deductions, led by SALT, exceed that, you could save thousands by switching from the standard deduction. Second, model your AMT exposure. The alternative minimum tax disallows all SALT deductions. If you earn between $220,000 and $500,000, you might fall into this zone, which could cancel out the SALT benefit. Run dual calculations on regular tax versus AMT with a qualified CPA or planning software. Third, use timing to your advantage. If your income or deductions swing year to year, shifting payments like property tax or estimated state taxes can optimize which year the deduction applies. For example, paying January's property tax bill in December could tip the balance in a high-income year. Fourth, reassess real estate decisions. Buyers in high-tax areas may return to the market if larger deductions return. This could boost prices in zip codes previously punished by the cap, like Westchester, Bergen County, or the Bay Area Hills. Fifth, document everything. IRS scrutiny is rising, especially on deductions that have previously been limited. Be sure to retain all property tax bills, state income tax statements, and payment records. Don't play close to the line. The audit risk is real. Let's also talk about small business owners and freelancers, one of the fastest growing income groups. If you file using Schedule C or operate an S Corp or LLC, the SALT cap change may alter how you approach quarterly tax payments. In states like New York or California, some business owners rely on pass-through entity taxes, PTETs, as a workaround to the SALT cap. But if the federal cap increases, those workarounds might lose relevance or require restructuring. Also, eligibility for SALT deductions could influence other business decisions, like whether to convert to an S Corp, relocate, or change how you structure your property and equipment expenses. This is not just a tax line item, it's strategic planning. Here's another nuance. We've seen employers in high SALT states offer tax equalization or relocation bonuses to offset lost deductions. If the cap lifts, expect changes in those compensation structures and possibly increased labor market competition in expensive cities. Let's now talk about the congressional angle. This proposal has bipartisan support, mostly from lawmakers in high-tax states. But it's meeting resistance in low-tax states like Florida and Texas. The projected 10-year cost, $80 to $100 billion, which has made it part of larger tax overhaul negotiations as the 2017 Tax Cuts and Jobs Act provisions begin expiring. So what should you do right now? Talk to your tax advisor before year-end. Run AMT versus regular tax projections. Review payment timing, especially property tax. Don't assume you benefit. Check AMT exposure. Keep all records clean. IRS audits are increasing. Also, don't wait for legislation to pass. Tax planning is most effective when done proactively. If you're in a high-tax state, run projections now using both the $10,000 and $40,000 SALT cap scenarios. This foresight can prevent costly surprises and help you align deductions with your broader wealth strategy. Let's recap. This proposed change affects millions of Americans, from W-2 earners to business owners. SALT deductibility would quadruple, potentially cutting your federal tax bill by $7,000 to $10,000 plus annually. It impacts home buying, retirement savings, compensation strategy, and entity structure. Planning early and strategically is critical. If you're serious about optimizing your taxes in the US, this channel is built for you. At CA Wealth Workshop, we don't just summarize the tax code, we break it down, simulate the numbers, and give you clear, professional-grade insights, all designed to protect your wealth. Subscribe if you haven't already. Like this video if it saved you a costly mistake, and drop your questions below. I reply to as many as I can. More US tax reforms are on the way, and next week I'll reveal which states are secretly becoming tax havens in 2025. This is CA Wealth Workshop. Strategic Finance Simplified.